Dr. Michael Burry is making headlines once again with his new short positions. His latest 13F filing gives us a glimpse of what we can expect out of the markets in the next few months and/or years. Just 7 days ago, Michael Burry's 13F filing was released. In this video, we will go over his top positions and break down his portfolio to give us a different market perspective. For those of you not familiar with a 13F filing, the Securities and Exchange Commission's SEC Form 13F is a quarterly report that is required to be filed by all institutional investment managers with at least $100 million in assets under management. It discloses their equity holdings and can provide some insight into what the smart money is doing in the market. However, studies have found that 13F filings also have serious flaws and can be taken at face value. Since August of last year, we've seen the US 10-year bond rise rapidly, just a little over 1 full point from 0.51 to now 1.62. Jerome Powell, head chairman of the Federal Reserve, states that we are experiencing transitory inflation and the inflation we are seeing is of no concern. He also says they have the tools necessary to maintain inflation levels at a favorable 2% or below, and based on their metrics, they don't see them worrying about inflation until 2023. What is interesting is that we are up just over 1 point in less than 1 year and half a point away from their targeted 2% level of concern. Michael Burry is calling his bluff and expresses it through his current positioning, and just to add more fuel to the fire, Michael Burry's Twitter account was deleted after SEC officials visited him back in March. Michael Burry has continued to express his market outlook via Twitter, and American officials are not happy about it. Back in 2019, he began to openly speak about the index fund and ETFs bubble, expressing his concern about passive investing, and I quote, "The simple thesis and the models that get people into sectors, factors, indexes, or ETFs and mutual funds mimicking those strategies, these do not require the security level analysis that is required for true price discovery." This is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis, in the price setting in that market was not done by fundamental security level analysis, but by massive capital flows. Let's take a look at Burry's latest portfolio. His biggest position is the infamous Tesla short that is valued at $534 million at the time of the filing. Before we all go running around like headless chickens and begin to short Tesla, here are some things to consider. Unfortunately, we don't know when he entered the position and how much time he bought on these Tesla puts. It is very possible he already cashed in some profits and now has a free trade, and/or have completely sold out of his position of some great profits. The last word of caution before getting excited on shorting Tesla is that he hedged this position with multiple bullish call positions like Google, Facebook, Kraft Heinz, IWO Growth ETF, CVS, and NetApp. If we add the values of all these calls, they add just a little over $450 million. That's about $50 million less than his Tesla short. He hedged one massive short with multiple long positions, and that is how he mitigated his Tesla short position risk. This is one of his two option strategies I see on his portfolio. The second strategy is TOT puts and TBT calls. He is shorting TOT, which represents the US 20-year Treasury bonds. He's basically saying inflation is around the corner and interest rates will rise. Now if we take a look at TBT, this is a leverage inverse 20-year bond ETF. I personally fold around several times with inverse ETFs, and they are pretty much a never-ending downward conveyor belt that will devour your long positions over time. Most of the time when these leverage ETFs hit rock bottom, the casino will do a reverse split and wipe out all the options market before turning back on the downward conveyor belt. What I'm trying to say is that these ETFs are beyond risky and impossible to profit from, but Michael Burry is convicted and bought options on TBT. You need to be an outlier in order to time and profit from such instruments. It's practically impossible to time these leverage ETFs. Here Michael Burry is long inflation with two instruments, and one of them being very gamble-like and aggressive. If we look at the rest of his positions, he owns stocks in real estate, consumer staples, healthcare, utilities, energy, and finance. A lot of these individual stocks are small cap stocks with potential of high growth. I like to watch Michael Burry's positions every quarter. I feel that most of us retail and smaller investors can learn and relate to his style of investing. Although he manages $1.4 billion in assets, that is small compared to the bigger funds. He invests on smaller cap stocks and trades the large cap stocks in most cases. These are my takeaways from Michael Burry and his latest positions. Michael Burry is known to have a lot of patience, thus making him one of the best. He began to publicly talk about an index and ETF bubble late 2019. Fast forward to today, it's been over a year and a half, and we saw a market correction last year with a very fast recovery. Basically, if you were short since his public concerns, you might have made some money during the pandemic last year, but that would have been it. Most people continued to short the market last year after the pandemic lows, and a lot of people shorting lost a lot of money during the V-shaped recovery. I'm not saying that that was the end of that bubble, but I am saying that it is extremely difficult to time these market downturns to be profitable. Now, his concerns are surrounding inflation. He thinks we will see interest rates rise very soon by aggressively longing instruments like TBT. Adding to his portfolio positioning, the SEC shut down his Twitter account, which also signals another red flag. I do think he's correct overall, but he's also going up against the Federal Reserve. He's held up against the odds before and rose above, but it took him years and a lot of money at risk to be correct. That type of money and patience the majority of us don't have. I do think it's time to build an inflationary position now, whether it's energy, consumer staples, finance, healthcare, or utilities. This is something that might happen as early as this year. If not, it can be a position you can build over the next couple of years for when the time comes for inflation and higher interest rates. Thank you guys for watching. If you enjoyed this video, make sure to like and subscribe, and I'll see you on the next one.